Guys, and welcome back to another series of videos by Geeked on Managerial Accounting. Today, I'm going to be talking about Chapter 4, which is relevant costs for decision making. So, in this chapter, you're basically going to be looking at the 5 decisions that I've listed here. And they are special order, make or buy, keep or drop, resource constraint, and sell or process further. Now, I'm going to touch on each of these briefly and I'm going to explain what they mean. And one key thing before I even start explaining this chapter, guys, is relevant costs. In this chapter, this is the most important bit. So relevant costs basically means that for whatever decision that you're about to make, you have to consider whatever costs are going to change because of that decision. So if any costs are expected to remain constant, then you don't even consider those. You're going to consider the costs that go up or down with the decision that you're about to make. With that being said, let's move on to the first decision that you may have to make as a manager, and that is a special order. So guys, a special order is when you want to accommodate for a one-time order that someone may come in and say, hey, can you make like for example, you're running a carpet business and this guy comes in and says, can you make 1,500 carpets for me before whatever date that he gives you? All right, so, and this guy, whoever he is, he comes in, he's going to give you the price that he's going to pay for those 1,500 carpets. You're not going to tell him what you're going to charge him. He's going to tell you the price beforehand. And then you have to consider, so we come here to this big formula that I've written out. The price that he has quoted, is it greater or equal to your relevant variable costs? Again, guys, relevant because you want to see the variable costs that change. Maybe they go up, maybe they go down. Usually variable costs go up with the number of units. So you want to see if that is relevant to your decision. So relevant variable costs plus relevant fixed costs. Again, fixed costs that may go up or down with your decision to accept the special order. Plus opportunity cost. So OC stands for opportunity cost. And for those of you who haven't really encountered this this concept before, what opportunity cost really means is that, so for example, this guy who came in and ordered 1,500 carpets, whatever space that you're going to use up for those 1,500 carpets, maybe you could give it out as rents and earn money like that. So is it really worth taking the special order rather than giving it off as rents? Maybe. That is what you have to decide when it comes to this. Other than that, like regardless, maybe even if the price that this guy charges, say it's 20 and all your relevant costs, all of this comes out to 18. Is that a good decision? Should you rely solely on the quantitative aspect of an order? Well, there are other factors that you should consider as well. And two of the ones that I can think off the top of my head are other customers will be displeased. Why? Because this guy, so for example, normally you charge a price of 25 normally, right? But this guy wants his order to be completed for 20. Won't that annoy other customers? Won't they say, well, lower the price for us as well? I mean, we're your regular customers. Why are you lowering it for this guy? Right, guys? So you really want to consider that. Is it really worth losing your regular customers just for this one special order, just because he's paying off all your costs and you're essentially going to make a profit? Even so, is it worth losing customers? Those are the quantitative and qualitative aspects that you should consider while making such a decision. Moving on to make or buy. So that is pretty much self-explanatory. It is when you decide whether to make your own products or buy them, outsource the production of your goods to somebody else. So when it comes to this decision, this is what you're basically going to consider when it comes to the monetary aspect of it. When it comes to the monetary aspect, you're going to see if the cost to buy, so whoever you're going to buy it from, they're going to tell you a price that, so for example, you're going to buy it off them for 40 bucks. So they're going to tell you, hey, we're going to make your products for you and you're going to pay us 40 bucks total and whatever. All right, that's basically all they're going to tell you. Or you can choose to make it yourself. So you want to see what your variable costs are, you want to see what your relevant fixed costs are, and again, you want to see your opportunity costs. Remember, it could be rent. So if you decide to buy it from someone else, maybe you can give your property off for rent or something like that, free money. But again, you want to see if the cost to buy is less than the cost to make it yourself. So for example, if the cost to make it is 38 bucks, then it's foolish to actually outsource the production of your product, right guys? Because you're basically making it for less money yourself. Why would you want to pay 2 more bucks for each unit that you could have produced for less? Again, but that is just the monetary aspect of it. Other factors that you should consider when dealing with an outside firm is quality. That is very important, guys. So if the quality is bad, so for example, when whoever you're dealing with, if their quality is not as good as your own quality, will that result in you losing customers? Will customers leave your business and go to I don't know, like rival businesses maybe? So will that really affect your business if quality isn't that good? What do customers value? Do they value like economical options, or do they value quality? So you're gonna have to carry out a market research and you want to see what customers value more, and then you want to go with that. Other things that you should consider are the person that you're buying it from. Are they ethically responsible? All right, guys. So in today's world, it is becoming exceedingly important for businesses to be socially responsible. So if the company that you're dealing with, if they're involved in malpractices, if they're not socially responsible, they employ children to manufacture their products, for example, then that won't rub off as good reputation for your business. So that you don't really want to deal with businesses who engage in illegal practices per se. So basically, those are two factors that I can think of when it comes to deciding whether you want to make or buy your own products. And again, guys, so on the exam, you're going to be asked, so you're going to be presented with a case. So you're going to want to present both the quantitative and the qualitative aspect of either decision. All right, so moving on to the third one, which is a keep or drop decision. Again, that is pretty much self-explanatory. So in this case, you want to decide whether you want to keep or drop a product or a department. Usually when you're facing such a decision, it's when a certain product or a department is not doing too well. It's making losses every term and it doesn't seem to be improving. So before you make the decision to drop, you want to consider if your contribution margin is less than your relevant fixed costs and your opportunity costs. If your contribution margin is less than these two, then that basically means that the product is completely useless. It is not even able to cover your fixed costs. So a product or a department that is unable to even cover its fixed costs is totally useless and should be closed immediately. When it comes to relevant fixed costs, guys, I'm going to go into more detail now. When it comes to relevant fixed costs, there are actually two types of fixed costs. So there are avoidable fixed costs, and then there are the annoying, unavoidable fixed costs. So when again, relevant fixed costs are always avoidable fixed costs. Unavoidable fixed costs are those parts of fixed costs that's something that you have paid. So for example, you take a course at Ryerson and you pay $1,000 upfront, right? And in the middle of the semester, you feel that maybe, you're not doing too well. So if you decide to drop out at that point, are you going to recover this $1,000? And the answer is no, because you paid that upfront. You know that you're not going to get this back. So an investment like this is called a sunk cost. So once you pay it, you're not getting it back. All right. So that is exactly what unavoidable fixed costs are. Something that you paid for in the past and cannot be recovered. So relevant fixed costs are avoidable fixed costs. You want to consider anything that happens in this region. So avoidable. So when you're deciding whether you want to drop or keep a department, you want to see if the unavoidable fixed costs are too much for you to handle. So if, for example, let's draw it up then. So you have department A, department B, and department C. And all these departments have an unavoidable fixed costs of 10,000. All right. So imagine now that department A isn't doing too well. It's not profitable and it incurs losses every year. So the company is deciding to shut this down. But these two are profitable, right? So these two earn a profit of, these two earn a profit of 5,000 at the end of the year. Both these departments earn a profit of 5,000, right? And an overall profit of 10,000 for the business, am I right? But this department is just able to cover its contribution margin. So contribution margin is that part of the business that covers this 10,000. So this profit is zero. So the company is thinking of like, why are we keeping this business or this department open? We should just close it, right? What will happen when you close this department down? This 10,000 is going to go to department B and C, and essentially that $10,000 of profit that you're earning right here is going to be canceled out by this 10,000 of fixed costs. So it's actually your entire business is going to go into a zero. So basically you're going to be break evening, if that's a word, break evening. I don't know. Basically your business is going to be earning a zero. So just because you decided to close this one department that was actually just doing you pretty good, like it was doing really well because you were still earning a profit of 10,000. I know all this seems very technical, but once you get the gist of it, once you start doing questions, it's actually very simple, and I shall be doing a question later on. All right, guys, so other factors that you can consider are, is the product complementary? So maybe it complements the other two departments, and if you decide to close it down, what happens then? Well, basically, you're going to lose business in these two departments as well because it's a complementary product. And customers are going to go away when they realize that one of the complementary products is not available anymore. So you might lose business even in that sense. All right, guys, so I've covered 3 of the decisions that you may have to make. We have 2 left, which I'm going to cover in the next video. And in the next video, I'm also going to do a question so that you can see how these concepts are applied. All right, guys, so stay tuned.